Most retail traders fall into a binary trap. You either stare at 5-minute charts until your eyes burn, or you tie up your capital for 6 months hoping a massive macroeconomic shift finally plays out. If you have a demanding career, trying to scalp the intraday volatility is exhausting. The constant need to make split-second decisions leads straight to emotional burnout. Think of the market like an ocean. Scalpers fight every tiny ripple. Position traders wait for the massive tide to turn. Swing traders are the surfers. They identify a well-formed trend, ride it for a significant distance, and paddle out. It sits right in the middle. You're aiming to capture moves of 100 to 200 pips over a span of a few days to a couple of weeks. Look at this comparison matrix. Scalping requires intense screen time for 10-pip targets. Position trading requires immense patience for 500-pip targets. The swing trader column hits that balance, checking charts once or twice a day to target substantial triple-digit moves with significantly lower daily stress. But grabbing those larger moves requires a specific operational trade-off. You have to accept the risk of holding trades open overnight, and you have to synthesize technical analysis with macroeconomic data. Today, we're breaking down the exact inputs, capital requirements, and strategic trade-offs of the 2026 FXNX swing trading blueprint. By the end, you'll know exactly if this framework actually matches your lifestyle and psychological profile. Let's start with the math, because swing trading requires a solid foundation. If you are starting with $200 and looking for lottery ticket returns, this strategy will fail you. You realistically need a capital base of $2,000 to $5,000 to execute this properly. That capital requirement exists because of a strict professional mandate. You can never risk more than 1 to 2% of your total account equity on a single trade. This flowchart shows exactly how to calculate that limitation. You multiply your account equity by your risk percentage, then divide that by your stop loss in pips multiplied by the pip value. That dictates your exact lot size. The trade-off here is straightforward. Mathematically capping your risk ensures you will survive the inevitable string of losing trades, but it results in a slower, more methodical path for absolute account growth. That slower growth is offset by a positive risk-to-reward ratio. By setting your take profit to at least double your stop-loss distance, a 1-to-2 ratio, you generate consistent profits even if you are wrong exactly half the time. However, holding those positions for several days exposes you to a unique vulnerability day traders avoid entirely: sudden overnight volatility and weekend market gaps. You defend against those gaps structurally. You place your stop losses wider, strictly below major market support levels, and you systematically reduce your position sizes on Friday afternoons before the weekend close. That is the core transaction. The luxury of stepping away from your screen for 22 hours a day is entirely paid for by your rigid discipline in managing that off-hours mathematical risk. You cannot swing trade every currency. You have to hunt for assets that move like a flowing river, not a choppy lake. And that starts by identifying pairs with consistent directional volatility. You measure that required movement objectively by applying the average true range, or ATR indicator, directly to a daily chart. This checklist graphic outlines the non-negotiable asset criteria. You need consistent ATR, and you need the high liquidity found in major pairs. Look at how the clean, predictable trend of USD-JPY compares to the erratic spikes of an exotic pair. High liquidity directly translates to tighter spreads, which reduces your costs over a multi-day hold. Applying these strict liquidity and trend filters means you will see far fewer valid trade setups each week.
You are trading volume for probability, which requires immense patience. When you do find a candidate, your technical toolkit spans 2 timeframes. You use the daily chart to read the overall narrative of the trend, and you zoom in to the 4-hour chart for execution precision. This chart shows a classic uptrend mapped with a Fibonacci retracement tool. By drawing from the swing low to the swing high, we locate the golden zone between the 50 and 61.8% levels. Layering a 50-period exponential moving average perfectly intersects this zone, creating a powerful area of confluence. Advanced frameworks like the ICT optimal trade entry are built directly on top of these exact foundational retracement principles. Technical analysis gives you the exact geographical coordinates of where to enter, but executing that trade requires the emotional discipline to sit on your hands until the price actually reaches that zone. Technicals provide your entry point, but they cannot sustain a multi-day or multi-week trend on their own. You need a fundamental catalyst pushing the market. Going into 2026, the primary engine driving these sustained currency trends is macroeconomic divergence, specifically the differing monetary policies of global central banks like the U.S. Federal Reserve. When institutions use opposing language, for example, if the Fed signals hawkish rate hikes while the European Central Bank issues dovish statements, that policy divergence creates massive, predictable directional flows in pairs like UR/USD. The Bank of Japan is another prime example. Their uniquely isolated monetary policy frequently puts them at odds with Western banks, fueling the massive, one-directional moves that make USD/JPY a historic favorite for swing traders. But do not attempt to trade the immediate release of high-impact events like CPI data or non-farm payrolls. The initial volatility will easily trigger your stop loss. Instead, let the dust settle. Use the actual outcome of those data releases to confirm and fuel a directional bias you have already established on your higher timeframe charts. Secondary macro factors provide additional fuel. Geopolitical instability drives flights to safety, boosting the US dollar, while rising commodity prices like gold drive currencies like the Australian dollar. This is the operational trade-off. It forces you to actively monitor economic calendars and interpret complex geopolitical data, which severely steepens the learning curve. But the payoff is clear. The most explosive, reliable swing trades only materialize when a pristine technical setup perfectly aligns with an undeniable macroeconomic narrative. Let's summarize the reality check. Swing trading is your best defense against screen fatigue, but it demands an offensive, highly structured approach to managing risk and conducting macro research. If you are trading with less than $2,000, if you are looking for daily dopamine hits, or if holding an open position while you sleep causes you to panic, you must avoid this strategy entirely. This quadrant chart maps the ideal candidate. If you are an analytical trader with a primary career, adequate capital, and the discipline to execute 1 to 2 risk-to-reward setups based on central bank divergence, you are in the swing trading optimal zone. Make no mistake, this requires active management. You are not simply parking your money in a passive index fund and closing your laptop for the year. If you fit that optimal profile, your next step is to utilize FXNX's institutional-grade economic calendar and 0.0 pip spread platform to execute this exact multi-day blueprint. The market exclusively rewards preparation. Accurately identifying your psychological profile and committing to the correct operational framework is the definitive first step to surviving and profiting in 2026.